Hey traders, welcome to Top Tier Outlook. Great to see everyone. Happy Sunday evening. We're taking a look at the open as we prepare for yet another exciting trading week. Last week, most of you know, as we started off Top Tier Outlook, and I did the videos for my YouTube channel, the Simpler Trading YouTube channel. I was bullish, right? And I was bullish, and most of you know that I was bullish based on a number of sectors that were indicating that the NASDAQ and potentially the S&P could be relative outperformers. Now, this wasn't guesswork. This wasn't optimism. This was not hopium. This was looking at the pieces of the indices that were indicating that, again, if you sort of think of the indices as an engine, as a motor, right? And it has usually three, if not four, cylinders. And each cylinder is a sector. And each sector has a high concentration weighting. So these cylinders aren't all equally contributing to the performance of the engine. This is just the way in which the markets that we trade are made up. So if I'm looking at the NASDAQ engine, I know that there's a cylinder called technology, communications, and consumer discretionary. And in that order, those cylinders contribute to the power output of the NASDAQ. For the S&P, it's tech, right? It's financials and healthcare. And the more of those cylinders, right, in this case, tech being joined by financials, when I've got more of these high concentration weighted sectors, these cylinders firing off, this is just going to be a better performing motor. So clearly I have sports cars on the mind or something, right? But that's the way the markets behave. So when we're thinking about the overall averages with that in mind, it makes perfect sense why it paid quite literally to stay bullish the NAS rather than, there's some big catastrophic fall to come. By the way, I've been hearing that all darn year. I wonder that's how that's been working out for them. Not well, unless, and I'll give them the benefit of the doubt, unless they've been trading the Russell, it's not been just the general direction of price action, right? The Russell continues to be the motor that has sort of a misfiring cylinder. It's got just the one, and that's KRE. So if there is a place to stay bearish, absolutely, there are pockets of bearishness in the broader averages, and that's the Russell, right? Not the NAS, not the S&P. The Dow's somewhere in the middle, but if we're looking for relative outperformance, the best downtrend, the best uptrend, we always should have two watch lists, right? One for shorts, one for longs. And as long as we think that way, we don't have to force ourselves, which is what most analysts and quite frankly traders do. They want to paint the whole market with one brush. You got lots of brushes, right? So at least have the two, a bearish and a bullish, and it's going to help you a lot more with directional clarity. All right, so with that being said, we'll get the top tier outlook out tomorrow. We'll talk about where my focus is, but I don't want to keep it a mystery. I'm going to continue to be bullish. In fact, as I like to say in any of our shows, whether that be here in Top Tier Outlook or whether that be the Charts and Coffee, Caffeinate and Dominate pre-market game show, we are going to talk our book, right? I'm going to talk my book. Who cares what I think? Only matters what I'm doing. Only matters what I'm trading. Going into the weekend, we held our long QQQ. Going into the weekend, we held our long SMH. If you want to check that out, if you want to check out the summary of those positions, what we did, why we did it, check out Simpler Trading YouTube channel and the Friday video. I went into a lot of detail as to what we were doing and why. And why also, for those of you wondering, Rog, how do I take the NASDAQ into the weekend? Well, and one of the reasons I was mentioning, I couldn't remember the specific overnight margin when I was cutting the video. I kept thinking 17,000, but I think it's close to 18.5 now. But the overnight margin on a single NQ futures contract was 17. I want to say it's been bumped to 18.5. $18,500 for one contract of the NASDAQ. That's how much money you need in your account at a minimum to keep one open position of that symbol. And you might say, Rog, well, the micros are less. And bots tell me it's 18,680. There you go. I couldn't remember what the exact number was during the video. I thought I know it's 17, 18K. It's on its way to 19. My point is there is a way to scale into numerous QQQ contracts to replicate much of the notional value exposure that you would get through the futures contract. Obviously not as leveraged, but certainly not unleveraged, right? So a lot of cool things happening, and really great week last week. And this is what we want to continue to do, press our advantage, right? Okay, so with that being said, let's go ahead and jump into the questions. As always, the best part of our show. And first up, good evening. Yes, it looks like midnight o'clock outside. I'm on the East Coast. It's 7 minutes after 6, and it looks like it's midnight outside. Oh my gosh. Yes, good evening, Matt. I was watching a video from 10 years ago. Wow. When I just used the wave. I see today you're using a bunch of other stuff. 10 years ago is a long time, Matt. Curious about all that. I think come check out what we're doing in Sector Secrets Mastery, or come check out what we're doing in Charts and Coffee, what I've done over the years. And by the way, you can go back 20 years and see the wave as well if you dig far back into the archives of the interwebs. So yes, the 34 EMA wave was a big part of what I did, as was support resistance, minor highs, minor lows. And I used a lot of Dow 123s. Those were things that I did 25, 30 years ago even. 10 years ago, we started, actually 10 years ago, currently 10 years ago, it's with Simpler, we started adding to that. We added the propulsion 10 years ago, which is a moving average cross, just automation. We added automation of Darvis. So what I've done is a lot of the things that I learned how to do manually throughout my 30 years, what I've been doing the last 10 years in a very focused way is ask myself, what subjective things am I doing? What things have I learned to see? Because I've been staring at this stuff for so long. And can I determine all the little pieces that make that valid and automated? So 10 years ago, we were using hourly price movement ranges, automated. 10 years ago, we talked about moving average crosses, automated. 10 years ago, we talked about Darvis levels, automated. And that's what I've been up to. Yeah. All right. Next up is, does my husband still trade with me? From time to time, Matt, he will. Not as much as he used to. It depends on, frankly, I mean, for lack of a better way to put it, if there's something he wants to buy, if there's something he wants to do. For those of you that might know, 2019, 2018, he decided to trade with me. He traded for about 3 months. The goal was, hey, whatever he does, whatever he can learn and make is his to keep. And he wanted to buy a Ducati. That was the plan. I said, hey, you make money trading, then yeah, buy the Duck. He made enough money. He doubled his account in 88 days. I think he turned 10 into 21,000, and he ended up buying his mom a car. So that was so he'll come back and forth. But I'll tell you what, I'm also grateful that he's not super interested in the market, because I don't know that that's necessarily the greatest thing in the world, because then I would be focused on the market all day long. And then when I go sit down for dinner with my husband, or we go do something, we're going to talk about more markets. So I'm kind of grateful that we can talk cars and racing and fishing and football and whatever else. So, all right. Next up. All right. Matt has another question. Price movement ranges. Yes. Why don't I use those on a weekly chart? Matt, so think about each indicator. So an hourly price movement range is based on the hour, that specific hour, looking back 6 months. And so that works great for 1 hour time frames, unless I like using that for day trading. The daily price movement range, DPMR, is looking at that particular session, Monday, Tuesday, Wednesday, Thursday, Friday. Again, historical volatility. So I like to use that for swing trading. The time frame and the time horizon works best on a daily time frame, or to about an hourly. So that to an hour. So I like to use the DPMR. Weeklies would require a different type of price curation. So that's really what I decoded, Matt. So I can't put a DPMR on a weekly. It's measuring the wrong thing, right? So if I'm going to use a weekly, I need to then start to study that week's behavior. And we've got to go back a certain number of years. And so that's where it's a different animal. But the curation is really important. It's not just I'm randomly picking prices to show as volatility-based support and resistance, as you know, but it needs to be a different curation. That's why it would not apply accurately on a weekly time frame. All right, next up, John asks, the SPX looks like it's breaking above the Darvis high from the 18th. How do we know if it will continue or fall apart? I'll tell you, John, here's the thing. I don't put myself in that position to have to worry about that. What do I mean by that? What do you mean, Rog? Doesn't continuation matter? It does. But I'm not going to look for continuation in environments where I don't have a trend. Continuation is likely a little bit higher on the 1 hour time frame as opposed to the daily. So remember, the folks that need continuation from higher highs are momentum players. And there's nothing wrong with that, but I'm not a momentum trader. So I'm not going to be buying at a higher high, needing higher highs still to come to pay myself. What I want to do is find a trend and then a pullback, right? Good old fashioned buy the dip. Dip could be support. Dip could be support in the form of a Darvis. Dip could be in the support of a 34 EMA wave, the DPMR. So I'll need that pullback. It could be a retracement of some sort. So how do I know, John? We don't. I mean, that's the only honest answer. If someone answers you differently than that, they are confusing their ego for an answer. We don't know. Is the probability higher in a trend? Yes, there's more probability in a green trend that we're able to continue to move higher. But remember, the reason I don't worry if that is true or not is I don't ever put myself in at the high, right? So for example, I could probably, and by the way, ES is what I use to understand what SPY or even SPX are doing. But let me show you what I did, right? So here's how we do this. And this is where I say I don't want to ever put myself in a position to have to need a higher high because I've entered at a high. Let's see here. I'm going to grab my drawing tools. Where are they? Here they are. So on the NASDAQ, we did a 1 hour NASDAQ long position. And the whole idea was to build a position in here, right? I'm not building a position with the higher highs of any of these large candles, as many momentum traders will do. Now, it could work great, sure, but it requires that we keep plugging higher because the tolerance for losing money, especially when playing options, if you're long calls in these surge candles, you are paying, frankly, overpaying because you're paying not only for the direction, someone is paying for the direction, but they're also paying for that obvious momentum. It's something everybody wants. I don't want to be there. I want to take advantage of a little bit of weakness. I like to consider this on sale. And then once it's on sale into support, I'll think of it that way. Rog, if something's a trend or even not, is it on sale in support, right? And if it is, then we have an opportunity to position ourselves with better cost and better tolerance for this stuff before we get that stuff. So I'm long, but I'm not long for any of these highs. I'm long from in this zone. So I hope that makes sense, John. I would do the same. I would do the same thing with ES, SPY, SPX, right? So the easiest way to play these strong moves is ask yourselves, why would I think it's going to continue in the first place? And how can I buy those pullbacks, whether that be a daily or a 1 hour, in a way that doesn't have me relying on higher highs throughout the journey? Immediate higher highs is what I should say. All right, Anthony asks, how do I choose my targets for the 642? Anthony, it's twofold. I can either go with the DPMRs, or a lot of times it's going to be time. Furman, are we in a short squeeze environment? Furman, moves higher, and I don't know why this is. Moves higher seem to have this thing of a short squeeze, or I'll be honest, Furman, and thank you for the question. I'm by no means directing my answer to your question, but who cares? I mean, really, it doesn't matter to me what the reason is. Only the structure matters, right? So I find anything that says, oh, this is a short squeeze, and, right? My thing is there a trend that validates a buy the dip. So I'm not talking my analysis. Everyone's all 180 bullish now. I see very few people that are actually long, right? I see a lot of people suddenly turning bullish at highs. Really? How about staying bullish on trends that have already organized and buy the dip, like the one that Powell triggered last week? Right? That's what I want everyone to be able to do. And you can do it. I don't have any secret powers here, but I'm always going to separate from my opinion and analysis. And hey, this is what I'm doing. These are the open trades that I have and that I'm directing traders into. So with that being said, it just never comes up for a minute. And again, I appreciate the question, but honestly, who cares? Right? What I want to know is that movement higher happening within the context of a trend? Is it happening on the heels of macroeconomic shifts like this one, by the way? And is it happening in an index where at least two of the three major sectors are firing off? That's what matters for follow through, right? Things like short squeeze. I mean, this is just techno babble that traders tend to use to, I don't know why they use it. Doesn't matter, right? It really doesn't matter. If it's the context of an overall uptrend, we focus on buy the dips because my career is built on one belief, really one belief. Well, two. One, position sizing and risk management is the holy grail. And two, healthy trends correct and tend to continue. That's it. Everything I do is built on those two beliefs. So I appreciate it. I appreciate the question. So the next thing is, how do I leverage technical analysis to gain an edge on this type of environment for today trading? Check out my videos, Furman. Look, that's a big question, right? You don't think I can answer that in a 20-minute show, right? How do I leverage technical analysis? Raghee, how do you trade for a living? Check out the free videos that I post over at the Simple Trading YouTube channel. I walked through why I was bullish on Tuesday and where and how to trade the S&P. We end up focusing on the S&P, the NASDAQ, and actually the SMH on Wednesday with Powell. Thursday, I should say. Thursday with Powell. And then Friday, we took profit and we took trades into the weekend. So if you want to see what I was doing before I did it, check out those two free videos. And I think you'll see what the thinking was. All right. Next up is 5-minute shorting on Tesla. It's Sunday. I mean, seriously? I don't know. I don't know. Let's look at it tomorrow. Yeah, let's look at it tomorrow. I'm not going to be trading Tesla on Sunday. I need to see what kind of volume levels we have into early Monday morning. Are we above or below with a lot of things. So can we 5-minute short a 5-minute trade Tesla? Of course. Is it going to be my go-to? No, probably not, my friend, unless it's a relative outperformer. XLY's been tricky. Amazon is usually my go-to for that. Tesla, if Amazon and Tesla and the NASDAQ and the XLY are moving together, maybe. But right now, I really don't know. Okay, next up is there automation for the previous session close? Mr. Walker, draw the line. Do I need to have automation for it? I don't think so. I'd rather spend a little bit of time actually looking at the chart and saying it's a really easy something. I don't have to do measurements or calculations. I'll look at the daily time frame. So for those who want to know, yeah, Rog, how would you do previous session close? You ready? Keep a horizontal line on your chart. So don't delete it. I like to make mine in blue. Okay. So that candle right there, that's the candle we'll be dealing with tomorrow. That means that this big tall candle, this green candle, was Friday's candle. I don't even look at the close. I just move that line to the upper edge where it closed. That's it. That's it. And what the cool thing is it makes me look at that daily for a moment. It makes me look at 5, 6, 7 candles, look at the general gist of the action, and then move the line. And that's it. So I'm not really in any rush to automate that. I kind of like simple things like that to make me go to that screen, look at it for a moment, move that line. It's a nice visceral nice visceral process that takes no time, and the margin for error is, there's no mistakes really that can be made here. If you want to be really specific, you can go back and say, oh, okay, go to the daily time frame. I'm on Thinkorswim, and I can see it's 15,583. So I can even put 15,583 in the value for that horizontal line, and boom, that's it. That's it, right? Really easy. Super, super simple. CNE, Deborah, hey there. Thanks for all that you do. My pleasure. How will implied volatility complement or distract the HPMRs? Implied volatility? I don't use implied volatility. It's inherently flawed. Oh my gosh, Rob. Now you're going to go crazy on a Sunday. Implied volatility is something that I'm not a big fan of using. I like using historical volatility. The problem with implied volatility is if you take a look at the way that it's measured, it's going to go back a year. And implied volatility is, if you look at the calculation, the best way to describe it, the reason it's flawed to me is that if we have a huge increase in implied volatility within the year, right, a year back from where I'm looking at it, it's almost like a sweater that's stretched out. It never shrinks back to its original size. All right. It never shrinks back to its original size. It's been stretched. So until it's able to reset over time, it's a lot of time, it's always going to calculate based on the biggest move that was made over a set period of time. I don't want my volatility to be calibrated to the most volatile thing that's happened. I want more of a accumulation of volatility. For example, when we pull HPMRs, DPMRs, we're looking back over 6 months. I'm not looking at the most volatile event over 6 months. We're looking at the typical move. So I'm getting a 68% probability. I'm just not a fan. So HPMRs and DPMRs do not care what implied volatility is doing. Implied volatility does not know what HPMRs and DPMRs are doing. They're two very different ways at looking at it. I just don't really look at IV at all. Really, frankly, never have. And so because of that, I really don't know the answer, to be quite frank, right? I really don't know why the, if it would or not, right? But I don't know why I would need implied volatility. That's just me. I know. Wrong. Could you be more of a heretic? Gang, I'm always going to talk my book. I'm always going to talk about what I'm in, and I'm always going to talk about what I use. And if I ever change my mind, I will come back and say, hey, gang, I tried out this thing. I tested it for 6 to 12 months. It really was a needle mover, but I want to do that for 6 to 12 months of testing. And if it yields a positive result, I'll put it on my chart. But very, very few things are able to really survive that stress testing to where I think that, wow, this is really a needle mover for me. So just something to think about. And no, one has nothing to do with the other. Absolutely nothing. Yeah. All right. So gang, that's it. So did I drop some crazy bombs on y'all? As far as, I think a lot of times the process of trading, it's so unique. So it's not a matter of saying one size fits all, gang. And it's not the ball cap, right? It's my saying, this is what I do and this is why I do it. And then everyone else at least has a chance to say, gosh, that resonates with me or it doesn't. And I think that's my job. On this side of the mic, on this side of the camera, my job is to say, hey, this is what I'm doing and why I'm doing it. And then everyone can make a decision based on that, whether it's something that they can implement as well, right? So that's a wrap, gang. I'll see you tomorrow for Charts and Coffee. Be good to each other.